In this video, I'm going to do a trade review for this short on NASDAQ on Wednesday, the 5th of November. It's a PM session short. So this is 3 p.m. right here. It just sold off into the close. I got to the charts right about here and was able to catch a little scalp down. Didn't hold it very long, but had a lot of very clear frameworks and signatures that I recognized in price and was quite confident of taking a short at this point. Now, the first thing you'll notice is that this is the 9:30 candle. It was a very bullish day, just rallying all day. So anyone who has been trading on this day and looking for shorts, we're getting punished the entire day. And usually by this point, even if people thought there was going to be a short, if they'd been trying all day, they wouldn't have the mental equity to be able to participate in this. So coming into the chart really fresh in the morning definitely helps me see things a lot more clearly. I'm going to do a quick top down, just starting on the 1 hour. You can see the 4 hour here, really obvious impulse high. It looks like we probably want to take that out. And that's that high right there. We fell just short of it, disrespecting this bearish order block as well. So it does look like it'll want to take out this high, which I'm expecting. However, why was I comfortable taking a short when we made smooth highs of it? Well, how the market works, how it moves is, let's say we have a buy side pull right here, which we do. And then price wants to take this out. So a lot of the time, what it will do, it will fall just short of the a clear point of interest, and then it will begin a market maker buy model, and that would basically be a consolidation. And then you got your first stage, second stage, accumulate some sell side. I'm not saying it's coming down here, but any sell sides, and then eventually take out that original consolidation and hits that high time frame pull. What that does is it engineers more buy side above this level and gives the market a chance to reaccumulate. And typically that would actually be reaccumulation, which would mean it would respect a previous area of accumulation. So let's say that we previously accumulated in this order block, it falls short of the draw, pulls back, and then we'll run it out. So I anticipated something similar happening here, and therefore was not concerned with us taking this high right away, and I was happy to see a bit of a sell-off. This is the 15-minute chart. We'll come back to this later, but you can see big rally, and this was the only time we really took out some sell side. Other than that, for the most part, it's just been making high lows. In the 5-minute chart, so this is where you'll be able to see some of the confluences that gave me the conviction. Now, the first one and the most important one was actually the fact that if you look at this hourly chart, this 3 p.m. candle fails to take out the 2 p.m. candle high. So 2 p.m. opens up, we make a low, dig back into the high, and then the next candle at 3 p.m. opens up, 1500, rallies, fails to take out that previous hourly candle high, and then eventually at 3:15, it just begins to break lower. Now this is a signature that I've called, or framework actually, and signature that I've called the squeeze reversal, and that's essentially when a candle on whatever time frame fails to take out the previous candle's high or low and immediately starts dropping lower. Well, this kind of immediately within the first 15 minutes. And what that indicates is that it's going to squeeze out traders. So in this case, it's a long squeeze because anyone who was long buying this rally, we then fail to take out that candle high and start aggressively moving lower. That indicates that we're going to target a very obvious pool of liquidity where trapped traders would reside. So anyone who was long, where are they going to have their stops? Well, obviously we've got these nice smooth lows down here, which we had not hit at this point. And below that, a more obvious swing low. I really like this impulse low down here. They had this big rally up to here, because that really stood out to me. Obviously, we've got a nice consolidation down here that we've dropped down into, and that's also ideal. And yeah, they gave me the confidence to see that, okay, well, because we have the signature and it's clearly making a break lower, I'm going to anticipate is that we should attack some obvious sell sides. And because we've been rallying all day, it made sense that we could easily come down into this range. Now if I drop into the lower time frame, I can show a few more signatures. And the first one is that, as I mentioned, we have this high way back over here. So this high, and I said that we could have a consolidation just below that and then sell off. Now, what are the signatures of a consolidation? Well, one of them, and my favorite one to look for, is actually when you have multiple hourly opening prices at the same price. And that's exactly what we have here. We have 2 p.m. opening up and running into the highs, and then 3 p.m. opening at essentially the exact same price, and then eventually selling off. That, a lot of the time, is a signature that you'll see in a original consolidation. What else do we have? Well, we have some, in ES actually, we have some relatively equal highs, and SMT in fact. So relatively equal highs in ES on multiple levels, and that SMT, but the smooth highs is a signature of an original consolidation as well. That is typically something you'll see. Nasdaq, not so much, but this does still classify as relative equal highs, and this is because we have a manipulation closure. This, I mentioned in a previous video, is another one of the very key signatures that a lot of the time does happen for original consolidation, and that's where you have a long wick on whatever time frame and then a closure beyond the midpoint of that wick, which you can see here. We close above the midpoint and then immediately reject lower. That is, in my eyes, the same as us leaving relative equal highs. We are disrespecting a PD array that should reject price lower, so by closing above the midpoint of it, and then we reject low anyway. So that's the same as us making these smooth highs and then selling off. This is only really a little bonus indication that this could be an original consolidation. So first of all, these two opening prices, that makes a lot of sense. But then that plus a manipulation closure gave me a lot of confidence. And then at this point, what I was looking at is, like, I would have liked to have got short around here. But you can see we've got a nice a smart reversal, lower sell, short-term, intermediate, short-term, second stage here. It digs into low with 3 drive, and then it rallies back up. Now, I actually only looked at it as this candle was already dropping lower, and I was thinking, oh, well, that would have been a great place to get short up there, but I'll have to see if it offers me something else instead. The reason why I thought that this would have been a good entry up in this fair value above this impulse high is because recently dropped below this low, where it's fallen just short of the sell side down here. But if you look at the order flow through here, it's very, very weak order flow. What I mean by that is that we're failing to get up into these gaps. Like, we didn't manage to close above the midpoint of this gap. And then you look at this gap down here, we left that entirely unfilled, just tapping the low of that and then selling off. We have this big up closing candle that is enticing people to buy, enticing anyone who wants to buy this dip to get long, and then eventually it rapidly overlaps, meaning that we have now trapped traders below this low. So anyone who bought up here, price doesn't want to reach that point to let them out of their position before squeezing down to their stops, which are likely at this low. That would have been a great target, impulse low with some move lows above. Kind of see a bit of a trend line looking thing here as well, so that's nice. But you can just see the really weak order flow and that it should be heavy. Also, time of day is 3:30 p.m, getting towards the close, 3:40, almost 3:50 p.m, which is at market on close macro, has this falling of price down here. But essentially expecting this gap to remain unfilled because of the weak order flow and because of the narrative behind traps traders. When we get this another big up closing candle, once again enticing longs, rapidly overlapping it, I'm expecting price to remain heavy below this low. The narrative right here is that we create this false low, having these 3 drivers into low, and then this big rally. Anyone who's thinking, okay, I need to buy this dip, they finally get this confirmation, a big green candle, and they're jumping along, buying up here. Now, when we sell off aggressively, I have the exact same narrative as up here, where I want to see price remain ideally below the midpoint of this bullish order block. This bearish order block, because it's I mean, really, you'd be using a mitigation block, which would be just the lower down closing candle, or the lowest down closing range within here. In this instance, I suppose you'd probably be using this, depending on what the 15-second chart looks like. But you can see that it is it remained really heavy, and that's given me the confirmation that we have the narrative of trap traders. Price doesn't want to reach up into here to let them mitigate and roll lower. But how did I get involved here? Well, I just sold at this candle's high, so got a really nice fill right there. But there was a lower time frame entry as well, which I'm going to show you, which offered a very, very tight risk reward for the sell-off. And I will bring that up by going to the 15-second chart. This is a impulse rejection to impulse rejection failure. Now, this only works when you have the narrative that we should remain very heavy and that we are in second stage of a market maker model, which in this instance, it's not particularly obvious. We clearly have a intermediate term high just here. And then you could see this as second stage. But then at this point, it looks like that's kind of played out. So maybe I was kind of guessing or forcing this to be what I thought it was, but it did work in any case. And what that is when we have a impulse low and an impulse high. So we rated the impulse high and rejected it, and now I'm looking for the impulse low that rated that high. I'm looking for a closure back above that delivers buy side delivery. So we take out a previous candle's high and then a closure back below. That only happens because this is all sell side delivery here. When we run back up, that is beginning buy side delivery, but only buy side delivery once we take out a swing high. And in this instance, I actually thought we did take out this high right here, but it looks like we didn't actually. So I'm not entirely sure how that looks on the even lower time frame. But the idea is that you wanted to run some sort of a short-term high above this impulse low again, and then get a closure back below. And so that was the entry signal for additional adding on, and the stop would have gone above this high right there. I was already positioned with the size I wanted, literally from this price right here, with a stop up here in this high for value gap. And so I didn't actually add in this area, but that could have actually worked. We got a very nice move lower immediately, so I took off the majority position relatively fast, and yeah, it was a good trade. This would have been a nice target, as I mentioned, just a really nice impulse low, and then beyond that, just sells off into the close. I actually completely forgot that it was approaching 1550, which is right here. So had I noticed that, if I'd actually looked at the clock and looked at the time of day, I probably would have had wanted to hold a runner and just had the stop at break even or something for 1550, because that volatility a lot of the time can deliver quite nicely, as we see here. That is essentially the trade. To recap, the most important points is simply that we don't need to take out this high because it can form a reaccumulation by dropping down into a previous area of accumulation. So not expecting that we have to take that out. What signatures does that look like? Well, original consolidation has those equal opening hourly opening prices, as well as that manipulation closure on that 1 minute chart. And then the most important part is that this hourly candle fails to take out the previous hourly candle high and starts trading lower. That tells me that it's likely going to be a squeeze, and I can identify the most obvious point areas where stop losses would reside and attack those. Now, the squeeze reversal is only effective if the narrative is in alignment with that, which in this case you can see that we clearly have been rallying all day, enticing long. So if we were to sell off aggressively, that can result in a squeeze, because whoever's been long all day, they are now forced to sell their positions at lower and lower prices, resulting in this accelerating price move into the lows. That'll do for this trade review.